I've been looking into the numbers behind the AI boom. And honestly, the more I look at it, the more I see something people really don't want to accept. Because if this trend continues the way it's going right now, AI won't just cool off. It will become the biggest collapse of our lifetime, and it will hit crypto long before anyone is ready for it. Let me explain exactly why. The first thing to understand is this: AI isn't being powered by profit, it's being powered by debt. Wall Street is pouring billions of dollars into AI, but the companies receiving that money aren't generating anything close to the cash flow needed to justify what's happening. We have valuations exploding into the hundreds of billions, and behind the scenes, many of these companies carry massive debt loads simply to keep their growth stories alive. And this gap between valuation and reality is getting wider every quarter. Before I explain all the danger points and what this means for Bitcoin, let me be clear. This video isn't financial advice. It's research, opinion, and my personal view. Always do your own research. And if you like our videos, hit that subscribe button. We're pushing for 10K subscribers, and I appreciate every one of you supporting the channel. Let's get into it. The AI sector today holds a giant share of the market's capital. Every major bank, every major fund manager, every big tech treasury is pouring money into one story. AI will change everything, and the companies building it will dominate the next decade. But here's the problem. This entire boom is being built on credit, not sustainable cash flow. Most top AI companies are not profitable. Most startups are running entirely on investor money. And even the biggest names, the ones with trillion-dollar valuations, are spending far more than they make. They are investing their profits, but also they're borrowing aggressively from the bond market to finance this race. And that's where the danger really starts. AI valuations today aren't based on proven business models. They're based on one huge narrative: growth at any cost. Investors aren't buying cash flow, they're buying hype. And the crazy part is, everyone knows it. Everyone knows these valuations don't match the fundamentals. But the bubble keeps getting bigger because people assume someone else will pay more tomorrow. This is exactly how every major bubble in history starts. Now, let's talk about the turning point, the Nvidia era. AI completely changed after Nvidia GPU boom. Once the market realized how essential GPUs were to training and running models, capital flooded into anything even remotely related to AI infrastructure. Every startup ran out to raise debt. Every tech giant started an arms race. And CapEx, the money companies spend on infrastructure, exploded to historic highs. We're talking numbers we have never seen in tech before. In fact, some analysts say CapEx now makes up as much as 75% of free cash flow for the biggest tech companies, meaning almost all their surplus cash is being sucked into data centers and GPU farming. This is exactly what happened in the late 90s. Back then, investors chased clicks. Today, they chase GPU cycles. It's the same psychology, different decade. And the part that really worries me is the dependency risk. The entire AI sector is tied to one single company: Nvidia. If anything happens to Nvidia's supply chain, if GPU shipments slow, if new chips underperform, the entire AI economy pauses. And here's what most people don't know. AI companies now make up around 14% of the investment-grade corporate bonds index, a bigger share than the banking sector had before the 2008 crisis. This is insane. Debt that used to support regulated banks is now concentrated in high-risk, high-spend AI companies that have no long-term cash flow stability. This is a systematic risk hiding in plain sight. And meanwhile, debt is exploding at a rate nobody is prepared for. Tech companies borrowed around $90 billion in just 3 months. Debt grew 400% in a single month during the peak of the 2025 AI financing wave. And US big tech issued over $100 billion of new debt in 1 year just to fund AI infrastructure. This is a bubble forming in real time, measured in billions. And when this bubble bursts, and it will. Here's the chain reaction that follows. The moment one disruption hits the sector, maybe a GPU shortage, maybe a failed model launch, maybe a major AI company missing earnings, liquidity will flee the entire market. First, tech stocks collapse. Then corporate bonds face stress. Then ETFs start unwinding. And crypto, one of the highest beta assets, gets hit the hardest. People forget something important. Bitcoin today trades like a macro asset, not like an isolated digital gold. It responds to liquidity cycles. It reacts to risk-off behavior. When big institutions deleverage, Bitcoin is the first thing they sell. We saw it in 2020 and 2022. And we saw it this year too when Japan's bond yields triggered chaos across global markets. Whenever liquidity dries up, Bitcoin moves lower, even if nothing inside the crypto ecosystem is broken. So imagine what happens when the biggest bubble of our generation pops. Short term, you get margin calls, ETF sell-offs, forced liquidations, redemptions, panic. Medium term, capital starts relocating out of high-risk sectors. Funds reduce exposure, debts get called, balance sheets shrink. Long term, many AI companies will simply not survive. The strongest ones will consolidate the market. But the majority, the ones that rely purely on investor money, will disappear. And while this entire process is playing out, Bitcoin will not be immune. It will feel every pulse of the liquidity drain. So, the trillion-dollar question is this. Why does this bubble keep growing even though every analyst sees the warning signs? The answer is simple. Because bubbles don't form from ignorance. They form from incentives. Investors know these AI startups aren't profitable. They know big tech is spending more than it earns. They know debt is piling up at a rate that makes no economic sense. But if you're a fund manager, if you're a Wall Street bank, if you're a corporate executive whose bonus depends on AI exposure, you keep feeding the bubble anyway. Because everyone believes they can exit before the crash. But that's exactly what people thought in 2000. That's what people thought in 2008. Everyone thinks they're the smart money until the liquidity disappears and the exits close faster than expected. And that's why the AI bubble is so dangerous. It's a credit bubble, a narrative bubble, a liquidity bubble. And all three are connected directly to crypto. So what does this mean for Bitcoin? Bitcoin's biggest enemy isn't regulation or competition. It's liquidity. When liquidity is plentiful, Bitcoin thrives. When liquidity is tight, Bitcoin struggles. Simple as that. And if the AI bubble implodes the way numbers suggest, we're heading into a liquidity squeeze that pulls money out of every risk asset on the planet. That doesn't mean Bitcoin dies. It doesn't mean my long-term thesis on Bitcoin is broken. It simply means that Bitcoin will experience volatility, maybe deep volatility during the adjustment phase. Smart investors shouldn't ignore these signals. They watch cycles. They watch credit flows. They watch the bond market. Because all three tell the truth long before headlines do. When you combine hype, depth, and dependency to one vertical, you get a bubble. So prepare. Stay rational. Stay aware of liquidity, and don't underestimate how fast sentiment can change when billions of borrowed dollars begin to unwind. If you want more macro crypto videos like this, make sure you're subscribed. And while you are here, like the video and leave a comment. These things go the long way. And as always, stay safe and I'll see you in the next one.